crude oil just surged 5.40% this week, a sharp move that's got risk desks paying attention. Welcome to the D-Risk Weekly Global Markets Brief. It's Saturday, August 15th, 2026. We've been watching a theme all week. Call it the paper exodus hypothesis, the idea that capital is starting to favor hard assets over sovereign paper. It's a story that's easy to tell off one headline number, so today we're going to actually stress test it against the full tape: equities, bonds, gold, the dollar, and volatility, and see if it holds up. There's already a tension worth flagging before we even get to the data. The US dollar is holding a bullish technical structure right now, even as some are questioning its fundamental footing. Let's find out which story the numbers actually tell. Alex, start us off with the international tape, Asia and Europe.
Thanks, Sarah. In Asia, the Nikkei surged 4.74% to 68,714. It is riding a massive golden cross, with its 50-day moving average at 67,227, sitting comfortably above its 200-day at 57,805. The Bank of Japan's hawkish shift is paradoxically supporting the stock market. Global investors are viewing the BOJ's hawkish shift as an official confirmation that Japan has successfully conquered its decades-long deflationary cycle. This structural shift is driving a massive re-rating of domestic financials. Meanwhile, the Hang Seng slid 2.15% to 25,117. The index is trapped under a structural death cross, as its 50-day at 24,648 remains below its 200-day at 25,717. Mainland growth fears are suffocating any tech-driven optimism there. Over in Europe, the DAX drifted 0.46% to 26,440 on resilient corporate earnings. Conversely, the FTSE 100 closed lower by 1.39% to 10,750, though the index hasn't slid below its bullish moving averages. A localized mining sell-off dragged the UK index down, completely decoupling it from the continent's resilience. Sarah.
Two very different domestic stories driving Asia this week then. Japan's move tracks with a re-rating in financials tied to the BOJ, while Hong Kong's slide looks like it's about mainland growth concerns specifically. Worth being careful not to lump those into one regional narrative until we see whether anything connects them. Let's bring it back to the U.S. and see how the cross-asset picture lines up. Rates, the dollar, commodities, volume, Alex. What's Wall Street telling us?
Wall Street's caught in a holding pattern, Sarah. Looking at U.S. futures, the S&P 500 drifted 0.22% lower to 7805, and the Nasdaq 100 drifted 0.15% lower to 30,142. Tech profit-taking capped the indices, even as cooler CPI data tried to provide a macroeconomic tailwind. In the bond market, the 10-year yield closed lower at 4.63%, which reflects the market pricing in a softer Federal Reserve path. The U.S. dollar index drifted 0.07% to 99.67. It maintains a golden cross with its 50-day at 100.55 above its 200-day at 99.19. But price has slipped below that 50-day line as momentum stalls. In commodities, crude oil surged 5.40% to $82. This is the epicenter of the geopolitical shock, though its rapidly descending 50-day moving average warns against chasing the rally blindly. Meanwhile, gold closed higher to $43.80, edging up 0.91% despite sitting under a longer-term death cross. Finally, the VIX slid to 14.25, reflecting a steady return of risk appetite in equities despite the commodity chaos. Sarah, back to you.
Thanks, Alex. So does the paper exodus thesis hold up? Mixed picture, honestly, and it's worth being upfront about that. Oil's 5.4% spike is the strongest single data point in its favor, though Alex's point about its own descending 50-day is a real caution against reading too much into one geopolitically driven week. Everything else pushes back on it. The 10-year yield falling means investors bought treasuries this week, not fled them. Gold, the classic hard asset hedge, is still stuck under a longer-term death cross. And a VIX in year 14 is complacency, not the mood you'd expect if capital were genuinely rushing for the exits. Where this does get interesting is the dollar. DXY's long-term structure is still technically bullish, but it's stalling right at that 50-day line, so next week's FOMC minutes are a real test. A hawkish tone that sends DXY back above 100.55 would argue against the fiat exodus story. A failure to reclaim that level, especially paired with continued strength in gold and bonds, is the kind of confirmation the thesis would actually need. We'll be watching that level closely. That's all for this week's episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in, and catch you in the next episode.